The theory of momentum investing is very simple. You simply buy things that are outperforming. So when they start to outperform, you buy them, and later if they start to underperform the stock market, you sell them. So a very simple concept. But let me show you how I put that into action. Now there's various ways of checking on performance, but what I do, I think, is the best way. And with this book, you're going to get a number of these charts that help you see the signals to buy and sell on the various types of assets, the general ETFs, the country ETFs, the industry ETFs. So you'll have this at your fingertips. So let's take a look at the chart. Here we have, we're looking at the Standard & Poor's 500 US index and the TSX Canadian index. And what we're trying to determine here is when we should own one or the other. Now, this line here, the red and the green, both of these are a running momentum performance. And it's 9-month momentum. So where the ETF is in relation to where it was 9 months ago. So here at the end of 2011, we have the Canadian stock market on that day was down almost 20% from where it was 9 months previously. Here in the middle of 2013, the Canadian ETF would be roughly the same price as it was 9 months earlier. Here in the US ETF, it was over 20% higher than it was previous 9 months ago. So that's how we have these lines built. And what you're looking at for is a crossover point where the underperformer starts to outperform the other. And for the US market, it happened right in about here, where the US market started to outperform. Now, to make it even easier to see, what I've done down below here is I constructed a line which is the difference between these two lines up here. So if we look closely here, we can see that right here, middle of 2011, the US ETF started to outperform the Canadian, crossed over the zero reference line. And I also put in this chart down below here a 5% plus and minus buffer zone, sort of a gray zone, so that once you buy something, you give it time to start a trend. So when you buy here for the first time, you only sell if you go below the minus 5% line. So nowhere in the next 4 years or 5 years would you have gotten out of the US market. So by having this gray zone, you're not buying and selling here, buying and selling here, so on and so forth. All of these cost you a little bit of return by getting out and back in again. So we look here and we see that, for instance, here, the difference is 25%. That's the Canadian market down here about minus 5%, and the US market up about 20%. So a difference of 25%, huge differences. So here you would have been getting into the US market here, staying in for 5 years, and you have all this great outperformance. So how does that stack up as far as the total amount of money you would have made by being in the US ETF rather than the Canadian? So let's take a look at that. I've actually calculated that. Here we are. If you would have bought in September of 2011, the US ETF was up 170% over that 5-year period. So you would have made 170%. The Canadian market was only up less than 50%. So well over 100% difference between the US performance and the Canadian. So that is the power of momentum investing. You can also see why. My clients and I celebrated right here in January this year. We celebrated missing the crash. This was a crash that the Canadian market had. It was down 23% in January. But my clients owned a lot of the US market because of momentum. So you can see why we were celebrating missing the crash, because we had so much in the US market. Now, another thing to think about as far as momentum trading versus other styles of investing is that most advisors are using a style where you construct a portfolio with a block of money in certain areas. For instance, they might say have 60% in the US market and 30% in the Canadian market. So as these markets go up and down, people reweight the various blocks. And if the block is too high relative to the target, they sell the winner and buy some of the loser. And they keep doing that on a regular basis. So you can see here, if you're selling the US market on a regular basis because its block of the portfolio is getting too large, and you're buying the Canadian with the money, you can see that you're going to give up a lot of the gain of the US market by doing that. And it goes against momentum theory. So this is another reason why I think this strategy is much better than the buy and hold, build your portfolio brick by brick and rebalance. That type of theory, I think, is no longer working. So that's how to use the charts to make the transactions for momentum investing.